One. Welcome everybody. Brian Hartstein, Director of Corporate Development here at Baintree. I've got Jonathan Jangle with me today, one of the financial advisors on our staff and part of the 401k team that's dedicated to servicing all of our 401k plan clients and employees and participants that we work with. So we do want you to know that in today's day and age of sheltering in place, we are staying 6 feet apart in this video, so we are adhering to the rules, unfortunately, that we have to live in. Hopefully, this type of environment that we are now encountering will be over soon. We ultimately don't know when. But we're here with a very timely topic for April for our 401k education module, where we would like to talk about the CARES Act that just came out, issued by Congress, had some very helpful provisions. We're getting a lot of questions in regard to that. So we thought we'd tackle some of the most important parts that you, as a participant in your 401k, have questions about. However, I do want to have one caveat to this, is that even though the legislation was passed, it is not a blanket legislative piece in terms of it applies to every plan that's out there. Each plan and its HR staff, the trustees that oversee it, all have to adopt that on an individual basis. So even though as we go through this language and you say those things are great, I'd like it to apply to me, you really need to check with your HR, you need to check with your plan, maybe even the third-party administrator that's helping do the administrative component to the plan, to make sure that the provisions that were in the CARES Act actually do apply to you today. Maybe they will tomorrow, maybe they don't yet. We don't ultimately know. You can certainly call our office and we can help you walk through those things. Again, we're here for anything you may need, whether it's financial questions, investment-related questions, risk tolerance, but we want to walk through this important piece of legislation today. But we do want to make that and emphasize that point that, again, it's done on a per-plan basis. So let's jump through and see what we have. Some really beneficial stuff. John, take it away.
Sure. So the first topic we're going to tackle deals with distributions or coronavirus related distributions. So there are some changes that allow additional accessibility to funds within your 401k. One of these is getting rid of the pre-59 and a half distribution penalty. So if you are not 59 and a half and you need to take some of those funds, before all of this happened, you would have an additional penalty. So the distribution is taxed as normal income for that tax year, and then you would have a 10% penalty for an early distribution. That penalty has now been waived as part of the CARES Act. So an important thing there to allow additional accessibility to your money. However, there are some restrictions still on the amount of money that you can take out. So those distributions are not to exceed $100,000 from 401k plans or IRAs. Now there are some ways that you can spread the taxes out over a period of time, so that's a 3-year period of time, so you don't have that large tax hit in one single tax year as well.
Yeah, and if you wanted to pay that back, let's say in year 2 or 3, you could actually, let's say you did borrow $100,000 from your 401k or your IRA, or took, not borrow, but took it as a distribution, and you said at one point, I do have that money. If you put it back in, let's say in year 3, you have the ability to mitigate those taxes that you have paid or would have paid.
Yep, so it gives you some flexibility there. Now, additionally, previously, if you were to take a distribution directly from your 401k plan, there was a mandatory 20% federal tax withholding. That has also been waived as part of the CARES Act. Again, gives you a little bit more leeway to do some proactive tax planning, understanding what your situation is this year, what's it going to look like moving forward, and plan accordingly.
Yes, and so the next part is 401k loans, but one thing I do want to talk about is when there's an acronym now for coronavirus related distributions. We're hearing them called CRDs. So if you hear CRDs, that's probably what they're referring to. And again, whether you qualify under that, it's very, very broad based. It's anybody that's impacted by a coronavirus related incident or employment issues. So again, I think most people are going to be able to qualify under what that is. But again, if you hear of a CRD, they're probably talking about that type of distribution.
Right, and one quick thing before Brian does jump into the loan provision as well. We've actually gotten this question a couple of times from clients. You can't actually take a distribution from the 401k as part of the CARES Act and then roll that over into another IRA. Not sure why you would want to anyway, but that that provision you can't do.
Yes, they did delineate that, and again, this is not supposed to be a way for you to take a distribution and then be able to treat that as a rollover. It's meant to be a distribution to help you because we're in a time of need. So, but again, different from a distribution is a 401k plan loan. And again, not all plans have loans. So if you're in a plan that doesn't have a loan, they have to do have a loan provision for this to apply. And if you are in a plan that does have a loan provision, they actually have to opt in to this new language so that some of these new rules apply. So the max amount of a loan is now doubled from 50,000 to 100,000. So you can borrow up to 100,000 of your vested benefit, which means the amount of benefit that's inured to you. And again, you can actually borrow 100% of your plan balance, but before that was 50%. So we don't see the ceiling going from 50,000 to 100,000 being as impactful as going from 50% to 100% of your plan balance. So for example, if you were someone that has $10,000 in your 401k, before you might have been able to borrow for only 5,000, now you could actually borrow up to 10,000. So again, that might make a big difference in terms of helping you get through this time. One thing we always counsel is that we understand people have serious things that they have to deal with in this new normal that we're living in. However, we still feel that borrowing from a retirement plan or taking a distribution from your retirement plan or your IRA account is probably the last place you want to go for funds. Right. If you have any other reserves built up, I know John does a lot of work with people and talks about emergency funds or building up a side balance for liquidity purposes. We urge people to try to hit those first. Again, if you have to, these are here for you, but we still feel like these types of plans are probably the last place that you want to go.
Right, yeah, and like you said, when we're doing personal financial plannings, we really look at things in a chronological order. So obviously we want funds accessible that you may need immediately. These are really earmarked in terms of 401ks and IRAs, earmarked to maintain lifestyle in the future. So setting up a plan that has some sort of chronological order that's specific to your time horizon is really important to have, and that allows you to then have a little bit more flexibility in terms of planning when unexpected events do occur.
That's a good point. And one other thing we want to point out for the plan loans is that for plan loan repayments, you can actually defer that, or excuse me, delay that 1 year. So you don't have to start paying those back right away, because obviously if you needed the funds today, you're not so focused on paying them back, you're focused on utilizing those funds. So you can delay those actually for up to 1 year, and you can start in the repayment process. So again, but there are some differences between the loans and the distributions, but again, they've increased the amount of the loans based on a hard dollar and as a percentage, and they've opened up the ability to take out distributions from the 401ks. So again, generically very, very beneficial. Hopefully you don't need those, but if you do, I would start with your HR department, find out if your plan has opted in and those do apply. If you're not sure where to go, you can always call us and we can try to help as well.
Good. So one last point that we do want to cover, and it might not be as applicable as some of these other provisions, but RMDs, required minimum distributions, have been waived for 2020 on all IRAs and inherited IRAs for those that had set up inherited stretch IRAs prior to the Secure Act being passed. So that's really important in terms of the tax savings. So maybe you're still working, contributing to 401k, but you did have an IRA and you were of the age where you had to start those required minimum distributions. You would still have had to take that RMD out of your IRA even if you didn't have to take it out of the 401k. Now, if you don't need to, you don't have to, which means tax savings for this year. Additionally, if you look at valuations, if you had market-based accounts, look at the valuation at the end of 2019 compared to now, we've obviously seen a depression in price, which means your RMD for 2020 was likely fairly high, and you would have had to take money out, have sort of that sequence of returns risk we always talk about it avoiding, where you have a high valuation based on the account in 2019 means you have a pretty large RMD, and you now take it from an account that's worth less than it was last year.
Yeah, and for younger participants, obviously if you've inherited an IRA from an older family member who unfortunately passed away, those rules apply too.
Yeah.
Right? So you might have said, hey, I don't need money from that inherited IRA, I've been forced to take it. You can actually waive that for 2020 as well. So it doesn't just affect people, I think, that are at the 70.5 year mark. It's
Right.
for people that might be younger who, inherited those from other family members. So again, like John said, it's a big benefit because values from last year, when you have to value these as of 12/31/19, are obviously in most cases much higher than your actual account balances today. We hope that's not the case, but for most of our clients, it probably is the case.
Right, so a lot of different planning points, and obviously this is not all of them. There's a lot of different actions that you can take right now. Educate yourself on what the current provisions are, how they fit into your overall plan, and then utilize and leverage these provisions for your best interest moving forward.
Right, and understanding that the trustees of your plans are literally right now in the process of evaluating these and deciding whether to opt in or opt out. So decisions are being made. Some may have not been made yet, but they probably will be. Remember, this legislation was just passed, and unfortunately, because it was passed so quickly, Congress didn't have time to think through some of the details that go into actually putting these things into place. So they leave it to us to do that.
Decipher it.
Yes, decipher what they meant, up to the TPAs that help administer the plans, up to your trustees and your HR department. So they're doing a lot of work trying to do the right thing for you, and that's what we're here to do. But most importantly, we hope you're staying safe. We hope you're staying well. We are here to help in any way that we can, so please feel free to reach out to us. Obviously, we're not doing live meetings here at the office, but phone, email, we're doing a lot of Zoom calls, conference calls. We can certainly help you as much as we can. So,
Okay. All right, well, I think that covers just about everything. So our contact information, as always, will be available. Send us an email, call us, and we'll make sure to take care of you.
Thanks, and take care, folks.